You've all had significant introduction to him since we've talked about him before. He was my colleague at Georgetown Law School, my senior colleague. But most people know him because there are so many books about international finance during the Asian financial crisis and during the Clinton administration, where he is actually a major character. And I don't know that many other people who are characters in books and actually get portrayed as having saved the world. So Dan is one of the only people I know like that. So it's just a real treat to have him. So thank you.
Okay.
We will go till about 4:50 because we are subjecting Dan to a whole day of conferencing tomorrow. So we're going to exhaust him tomorrow as well. So don't want to take up too much of his time.
Okay, thanks, me too. I'm going to talk about banking and specifically the international banking arrangements that have been concluded under the auspices of the Basel Committee on Banking Supervision. But I want you to understand, and you being a somewhat more general audience, want you to understand that I regard this as a case study, even if it's a study of an exemplary case, of an effort to, as I put it in the title of the talk, to regulate transnational economic activity in a world of nation states. Economic globalization has been largely a story of overcoming physical and legal barriers that previously rendered prohibitive the cost of sending various forms of economic inputs and outputs across national boundaries. So the successive advances in transportation and information technology have allowed cost-efficient means of moving things across national boundaries. The successive rounds of international trade negotiations since 1947 have reduced barriers in trades and tariffs and quotas and non-tariff barriers. This is the story that has been told and that continues to be told. The issues then have frequently been framed as how much is enough? Where do we start treading on national sovereignty because we have insisted or enforced through an international agreement that there shall be no state interference with some company doing business in country A, even though the company is from country B. That issue is still an important one and will, I think, indefinitely be an important one. But another issue has emerged over the last 10 years or so, actually 15 now if you go back to the origins of some of the other agreements. And that's the question of, well, what happens when the onward march of globalization has proceeded to the point that you have genuinely global industries in which companies have become transnational actors who are conducting their business simultaneously in many countries around the world, where the mode of regulation that proceeds from a purely national government seems not up to the task of effectively achieving the ends of regulation. So a very prosaic but important example is when there's an international cartel and no single country is able actually to prosecute the cartel successfully because the evidence that would establish the existence and activities of the cartel is spread around the world. That phenomenon gave rise to the rather extensive cooperation among competition enforcement agencies which exists today. Now, put aside for a moment the quite controversial issue of whether there ought to be regulation of a particular sort, banking, pharmaceutical, securities, it almost doesn't matter what you plug in there. And put aside for a moment the issue of whether, even if there should be regulation, it should be internationally grounded regulation. But instead just think analytically about what the result is if you do transpose economic regulation to an international level. What you do when you transpose regulation to an international level is to create an interaction between your domestic regulatory paradigm of, in my case, banking law, on the one hand, and on the other hand, the potential but also constraints of an international arrangement. Now, this sounds obvious, but like many obvious things, it seems to have been overlooked in much of the thinking and writing about international regulation. When you're trying to put together your international arrangement to achieve some desired cooperative end, you are not getting rid of all the issues about the regulation that exists domestically. So, what's the best approach to achieving the regulatory end you're trying to achieve? Is there a gap between a nice textbook notion of regulation and what the administrators are capable of? How does the political economy of the country affect and even distort the achievement of those regulatory ends when you have real people functioning with their own incentives within agencies or the legal system? Are government employees of whatever branch capable of implementing a sometimes sophisticated regulatory paradigm? None of those issues goes away the moment where you say, gee, we need international cooperation to deal with transnational banking. But what does happen, I think, is that the international arrangement and the domestic arrangements begin to affect one another. In most areas, the impact is not that great because the integration has not proceeded very far. But in banking, it's proceeded quite a ways indeed, as a result of which it has become, I think, a test case for thinking about whether it is realistic to achieve effective regulation of transnational actors in this kind of international cooperative mechanism. Okay, so now that's the abstract introduction to how we're trying to think about it. Let me tell you a little bit about the Basel Committee. The Basel Committee, first the context within which it arises. The banking industry, in some respects, has been a pioneer of globalization. And they were pioneers at the same time that the people in Conestoga wagons were pioneers. Banks had international operations. European banks had extensive operations in the Western Hemisphere from the early 19th century onward. Extensive lending in the United States and in South America. There were both bond issues and bank lending that were responsible for the creation of the transcontinental railroad network in the United States, for much of the infrastructure in Argentina and some of the other South American countries. So banks have been international players for quite a while. By the 1970s, commercial banking had a set of genuinely global dimensions. Increasing economic growth rates outside of the industrialized countries had expanded the number of markets that existed. The successive revolutions in information technology had reduced to virtually zero the cost of transmitting information and often money across national boundaries. The reduction of formal barriers to entry into other countries' banking markets had made it feasible for a Citibank to operate in 100 and whatever it is countries around the world. Deregulation had freed commercial banks to engage in lots of activities that they had previously been prohibited from engaging in. The growth of the euro markets had created a center of international banking within which the major international banks confronted or dealt with one another all the time, because that was where loans would be syndicated. There were physically present representatives of the major international banks through their London offices putting together these big syndicated loans all the time. The par value system of exchange rates that the IMF had created at the end of World War II had collapsed by the early 1970s, meaning we now had fluctuations in major exchange rates, meaning there was a big market for trading in foreign exchange rates. And who did a lot of that trading? The big international banks. And finally, the explosion in innovation in financial instruments, which has not ceased as we sit here today, created a whole new set of opportunities for banks. And many banks saw that once you had developed a particular financial instrument which seemed to be profitable, it was in their interest to try to get that instrument around the world as quickly as they could before other people caught on, in order to take advantage of whatever first mover advantages would exist. So that's the deep background of the banking industry as it stood and was evolving in the 1970s. In 1974, a series of bank failures, Italy, Germany, and the United States, woke up the banking supervisors, not just in those three countries, but in all of the European, North American countries, along with Japan, to the fact that their banks were now deeply interconnected with one another. When the Italian bank or the German bank failed, each of them owed a lot of money in the interbank lending market, oftentimes the overnight market, to banks in North America and in one case Japan. The result of those failures was shakiness in banks halfway across the world whose balance sheets the day before had looked terrific. But because of the failure of a bank somewhere else, which owed the bank in your country a lot of money, all of a sudden the balance sheet didn't look so good. So the bank supervisor said, gee, we can do as good a job as you possibly can examining our bank right here in New York City. We send our team in, they look at the balance sheet, they inquire about the creditworthiness of the lending, they make sure that the executives know what they're doing, they make sure there's no insider lending, they make sure that capital standards have been adhered to, and all of a sudden, out of the blue the next day comes the failure of some bank in Italy or Germany, and all of a sudden our guys are shaky. Well, in those circumstances, achieving your domestic regulatory end, which is to say, safe and sound banking system, becomes not impossible to achieve, but more difficult to achieve in the absence of some form of international cooperation. Okay? So, in 1974, following these bank failures, under the auspices of something called the Bank for International Settlements in Basel, which is a bank for central bankers, basically, there was set up the Basel Committee on Banking Supervision. It had a different name, but that's what it now is called. Remember, there's this legacy of cooperation among central bankers, which also reaches back, in some cases, centuries, but certainly to the 19th century and the gold standard. There's an institution founded in the 30s, the BIS, which has organized central bankers in a formal sense to interact with one another, to deal with one another. As a matter of fact, in the 70s, bank regulation in most important countries, financially important countries in the world, was the province of the central bank. So the Bank of England was the regulator of banks in England. It isn't today anymore, but it was then. The Federal Reserve Board was an even more important bank regulator then than it is today. So they said, well, we got to do something about this, so let's start this classic response, let's start a committee to talk about it. They brought in other supervisory agencies. They said, okay, let's try to fill the gaps. Let's fill the gaps in coverage and supervision of banks. So one of these gaps is when there's an interbank transfer and there's a time difference so that one bank transfers the Deutschmarks or receives the dollars first but hasn't transmitted the Deutschmarks yet. If there's a failure between the time that those transfers are effected, we've got a big problem in the other bank. So let's see what we can do about clearing and payment systems to take that problem. So they kind of went down the line of what were the problems. And they began to address them systematically, but informally. There was no constituting document, there is no treaty, there's nothing that looks like the sort of thing you find in an international law book that put this organization together and reflected its output. Its output was written down, but it's all non-binding. And it all says, they make very clear, this stuff is not binding as among the regulators. And remember, this is not the foreign ministries that are negotiating. These are the actual regulators themselves who have come together. Then another gap becomes painfully clear in the succeeding years, with BCCI, the Bank of Commerce and Credit International, being the best example. When you have a big international bank operating, they can move around to the different countries in which they have subsidiaries or even branches sometimes, the assets that they have within the family of the bank as a whole. So if you have some shaky assets, the repayment of which is questionable, and it's time for the Bank of England to do your bank examination for your British bank, your British sub, why then, the week before, you transfer that asset to your Luxembourg subsidiary. The Bank of England comes in, they look at your assets, they see a couple of questionable things, they ask questions, you answer the questions, it's okay. I say, that's great. 2 weeks later, it's time for the Luxembourg bank examination. So you transfer the asset right back to the UK. The Luxembourg bank well, regrettably, the Luxembourg bank examiners don't show up, which is one of the big problems. But in theory, they should. And they ask, well, what do you got here? And they don't see anything questionable either. So nobody ever sees the questionable asset because the bank is shifting it around. In the absence of, this is a term of art, in the absence of consolidated supervision of the bank, worldwide consolidated supervision, backed by the power to get real-time information about what each component part of the bank is doing, nobody gets a clear sense, no regulator, no supervisor gets a clear sense of what the bank is up to. Right, so they began to address that problem, and they have something called the Basel Concordat, which tries to allocate responsibility as among host and home countries for this form of supervision, tries to make sure that there'll be one supervisor who's at least nominally and in some real sense in charge of looking at the whole bank. So you see what I'm getting at here. They're going kind of one by one. We find a problem, we find a negative externality here, let's go after it. But there's not kind of a grand plan. All right, so far it's very processy. I mean, important process, but process. Supervisory cooperation, make sure the gaps are filled, that kind of thing. It's not really substantive bank regulation yet. But now that comes. As you all know, in the early 1980s, Mexico, Brazil, most importantly, and some other Latin American countries defaulted on large amounts of debt that they had borrowed from money center banks in the United States and to a lesser extent in Europe. The result of those defaults was to place at substantial risk the balance sheets of some very large American banks, to the point where there was a reluctance to write off those debts, because had it been done, the bank may have been technically insolvent, which would have created a bit of a problem in the United States. The history of the lost decade that ensued in Latin America is its own tragic story. But for bank regulatory purposes, the outcome of all of this was that the United States Congress insisted that bank capital levels be higher than they had been before. Okay, now we need another little pause to explain to you why. You may already know this, but if you don't, you at least have an idea in about 30 seconds from now. Why do you need to regulate bank capital? We don't regulate the capital of most companies. If someone doesn't want to lend to the company because they don't think they have enough equity capital, they don't lend. And the company says, we got to respond to that, we'll get more equity. But the government doesn't come in and say, you got to get more equity. When you're talking about a bank, first off, banks are the most highly leveraged companies you're ever going to see. Why are they most highly leveraged companies you're ever going to see? Because most of their capital comes from deposits. A little lower proportion than 30 years ago, but still a majority of the capital of most banks comes not from shareholders who have purchased stock back at some point in the past, but from depositors. We don't tend to think of depositors as extenders of debt capital to banks. We think of them as customers. But that's exactly what they are. Your bank, you have lent money to Wachovia. And that's where they're getting their capital that they're turning around and lending out. Now, so they're very highly leveraged. That always makes you a little worried about a company. But okay, so they're highly leveraged. What's the problem? Well, in order to protect our all our citizens who think of themselves as customers of the bank rather than as creditors of the bank, we have deposit insurance, which means that you never worry about what Wachovia is doing. Not a single one of you in this. I've taught banking law since I started teaching at Georgetown. Not a single one of my students has ever confessed to paying any attention to the financial soundness of the bank and what she or he had their money. And that's because, I mean, if they had done it, then I would have worried, okay? Because they were wasting their time. They didn't need to do it, right? It's because they know that if the bank goes south, that the Federal Deposit Insurance Corporation will write them a check in the amount of their account up to $100,000. Now, they're the little guys. The big guys out there in the world, bondholders, other banks, investment banks, they're pretty certain that no matter what happens, the Federal Reserve Board will not allow Citibank to fail because they're worried about what will happen to the economy if all of a sudden Citi isn't there tomorrow and everybody's trying to get their assets. As a result of which, there is a doctrine that is purported to be held by the United States government, which the United States government says it doesn't have, but which everybody believes it has, which is the so-called too big to fail doctrine, meaning that these guys are just too big. We can't let them fail. And what does all that mean? That means that other debtors of the bank, other creditors of the bank, understand that they're going to be protected, so they're not doing the kind of assessment of their risks in lending to the bank that they would if they were lending to, I don't know, SmithKline Glaxo or GM or somebody like that. Okay, so all right. So for all of these reasons, you've got a circumstance in which the bank regulators in all countries long ago figured out we have to require certain minimum levels of capital, because that protects us against loss. If they've got capital, that means there's a buffer against loss. Okay, there's a very big finance literature on all of this. Obviously, we don't need to get into that. You just need to know that capital regulation has become central to prudential bank regulation in the 21st century around the world. So, Congress back there, now we're back to the story. Congress in the 1980s says, all right, we will help bail these banks out by giving more money to the IMF so that it can help the countries who will then pay back the banks. But there's a quid pro quo here. We want bank capital up, and we want you, the Fed, and the comptroller to raise bank capital requirements. And the Fed and the comptroller say, well, I guess that's a good idea, so we go back and do that. And then the banks start yelling. You say, yeah, but why do we have to raise our capital when the European banks don't have to raise their capital? And Congress said, okay, go out and negotiate something with the other banks from big financial countries so that everybody will have enough capital. The result is the Basel Accord on capital adequacy that was completed in 1988, which at the time was heralded as a breakthrough in international regulatory cooperation. It's 30 pages that essentially say, here's what the requirements for bank capital regulation are, no matter where your bank is located, so long as it's one of the countries that's a member of the Basel Committee. There are 13 countries, the ones you'd expect mostly, that are members of the Basel Committee. And now, what's happened since then is countries like Singapore, Hong Kong, which are important financial centers, they now have an ancillary relationship with. They have their own little organization which links up with the Basel Committee. So you cover all the big financial centers. So they said, look, this is what we're going to do. We're going to have these capital standards for every internationally active bank. That's the law. All right. So now we're saying there is an international understanding, not a binding agreement, but understanding, that every national bank regulator shall put into its law this 30 pages of provisions. Harmonization. Harmonization of what? To a greater extent than the European Union was ever able to achieve it in most areas, even though they had a mandatory, theoretically mandatory mechanism for doing so. This then becomes these capital adequacy agreements then become as I said earlier, the exemplary case for just about everything. So you like, Anne-Marie Slaughter likes, you guys know about the Anne-Marie Slaughter stuff? Have you encountered this? No, you haven't encountered this. You don't have any Anne-Marie Slaughter acolytes at Duke Law School, huh?
I'm half an acolyte.
Half an acolyte? Okay. Well, so you carry one candle, but not there. So she's very big. You know who she is? She's the dean of the Woodrow Wilson School. Used to teach at Harvard and Chicago law schools. She's very big on the idea that there are so-called networks, transnational networks of regulators from different countries who provide an effective means of organizing international activity. Now that doesn't do justice to her theory, but that's sort of her. There are other people who are very big on seeking regulatory convergence, regulatory harmonization. There are still others who fear that the phenomenon I described at the very beginning, whereby international arrangements are mostly about telling states what they can't do. Here's an approach that has states reaffirm positive state action, regulatory action. And that's seen as a counterbalance to the WTO approach of saying to states, you can't do this, you can't do that, you can't do this, you can't do that. So lots of people kind of glommed onto the Basel Committee and said, boy, it could really happen here. Look at these capital adequacy standards. Now, to show you that this was a real thing, there was also a lot of writing by people who hated it. Okay, so like the public choice guys are writing, John Macy, then at Cornell, now at Yale, writes an article that basically says, yeah, you know what this was all about? The regulators in the different countries are becoming irrelevant. They're looking for a way to make themselves relevant, so they went off and did an international agreement. All right, now, it's a wacky theory, but I guess I'm getting recorded here at St. John's. But that's okay. It is wacky theory, but when one of the top public choice people in the country is zeroing in on the Basel Agreement, you got to figure there really is something new happening here. And I will tell you, in the late 80s when this happened, I was excited by it. Because I'm one of the people who's been worried that the so-called negative approach to economic globalization, saying states, you can't do this, you can't do this, you can't interfere here, you cannot, we're going to overturn your health and safety regulations because they interfere with trade, that was neither good policy nor politically sustainable as within Western European and North American countries. So I thought, gee, this is a great development. Why is it not? I have now concluded with the next iteration of Basel II. Basel II has now been a new set of capital standards. That it's not as great a development as I had hoped. And what I think Basel II does is to reveal the limits of international arrangements, that is, arrangements, take it very literally, arrangements among nations, or in this case, among national regulators, in trying to regulate transnational economic activity. I don't have time to give you the full-blown description of how we got Basel II, but let me give you a couple of the highlights. So remember I told you Basel I is 30 pages long? Basel II is 300, okay? And it's mostly formulas. I did an early version of this talk down 15501 a couple of years ago. And I did it with PowerPoints and stuff. It was a faculty workshop. It wasn't mostly. I did a faculty workshop, and I put up there the Basel under Basel I how you calculate capital. And basically, anybody who knows how to do percentages and subtraction and addition can do it. So about 60% of the law faculty could do it. Okay. Then I put up on the next slide the formula for calculating the risk attached to lending a mortgage up. And it is literally about, I think I counted once, I think it's 215 characters long. Okay, with functions of this and this and this and this. And they all just kind of looked at it, and except for Lisa Broom, who sort of understood what it meant, the rest of them said, well, this is ridiculous. This isn't law. It is chock full of, it is intensely complex. And here's the next point. It is really hard for a regulator to figure out if the bank is doing what it's supposed to do, because the bank is supposed to be assessing it on its own the credit worthiness of an individual borrower and then feeding that assessment into this complicated equation, which then spits out how much capital they have to set aside in order to be a buffer against a loss for that loan. But that model that says where the credit, what the credit worthiness is, that's an opaque model which varies from bank to bank, which is literally being produced by MBAs from your next door neighbors here who have concentrated in finance. So you got that problem. Can the regulators actually figure it out? Well, that's a problem with just domestic regulation. But think of it now. Now you have taken that problematic from the national level into the international arena, and you've just multiplied the problem. Why? Because just as we, I might say for these purposes, the Banking and Financial Services Committee of the Congress of the United States would have difficulty figuring out if the bank regulators were doing their job. So the regulators have trouble figuring out if the bank is doing what it's supposed to do. The oversight people have difficulty figuring out if the regulators are doing what they're supposed to do. Now you take it to the international level, and our regulators are going to have trouble figuring out whether the European regulators are doing what they're supposed to do, and vice versa. Right? So instead of the international arena helping to solve a problem that comes from a domestic regulatory paradigm, it's exacerbating the problem. Or it's at least not solving it, and I will argue that it's exacerbating the problem. So what else has this international arrangement done? Well, when you have a domestic banking issue, should we have more capital, less capital in the banks? And you have a hearing in, let's say, the Financial Services Committee in the House, I can pretty much tell you, you just give me the list of who's on the Financial Services Committee, and I can tell you who leans over and starts peering at the banks and saying, you guys need to have more capital, you're just counting on moral hazard and all the rest. And which members will sort of say, well, we don't want to constrict the amount of money the banks can lend. Point, though, is it's going to be a robust debate. Depending on the composition of the House of Representatives at that particular moment, it will go in one direction or another. But it'll be centered around that set of issues. Banks versus the government. Banks versus the taxpayers. That's the right debate. That's a good debate to have. You take it international, and you know what the debate becomes? Our banks versus their banks. It's just like a trade negotiation. In a trade negotiation, what is it like? Our companies versus their companies. That's what we all go back and forth with. Well, in this Basel II negotiation, my favorite piece of evidence here, November 2003, 16 members of the House Financial Services Committee sign a letter to the U.S. banking regulators saying, we think that our banks are not getting enough advantage out of this agreement. So you maybe want to do this to lower the amount of capital they would have to hold compared to Europeans. Now, 16 members, so what? You can always find 16 members willing to sign something. Well, that's actually true. But this particular group of 16 went from some of the most conservative members on the Financial Services Committee all the way to two of the most liberal members of the Financial Services Committee, one of whom I've known for many years, and I've never heard her say anything good about a bank. Never. Never, ever, ever, until this letter, because at this point it was our banks versus their banks. So this different dynamic clicked in. Okay, third point about this. Third point about this is that in order to do this write these 300 pages of formulas and regulations, the regulators had to work very closely with the banks. The banks have the models. All right? So, they go to Basel, and sometimes they did their meetings in exotic other locales. In the winter, they didn't go to Basel. And they sit down with the technical people and they talk about all this stuff. And oh, sure, when the proposal comes out, they post it on the website. Right? But how'd the proposal get that way? It got that way through this very close working between the bank technical people and the technical people from the central banks. Now, you might say, how else could you have done it? And I would say to you, you're right, you couldn't. If you had just had the technical people from the regulators sit in splendid isolation and do this, it would have been ridiculous. Okay, they would have just made all kinds of mistakes. But doing it this way, particularly at the international level, you put together these dynamics of work for our banks, and the only way we can figure out how to do this in a technically sensible way is to get the banks to tell us what the right thing to do is. And at the end, it's going to be so opaque that no one's actually going to be able to figure it out anyway. Okay. Now, if you think I'm exaggerating how this all works out, let me tell you the outcome. And let me tell you why I've spent so much of the last 2 years on the public policy side of this stuff, trying to stop this thing from coming into effect in its present form. So finally somebody said, gee, maybe before we put this thing into effect, we ought to run some tests to see what the effect will be on capital. Okay? Because they went into this exercise by saying, we're just trying to make the capital standards more risk sensitive, which is a good aim. You don't want to have a set of rules which doesn't really reflect the risks. But we don't want to change the general levels of capital. Right, so they do this test. Guess how it comes out? Capital levels will go down 20 to 25%. 20 to 25%. Now, they said, well, we may have made some errors along the way. A very astute, well, there's a very independent-minded, this means he has no banks for clients, finance guy in London. I don't know where he makes his money. He doesn't seem to have any financial institutions as clients, but that's why he writes what he writes. Who wrote a little piece saying, if you had said to banks, how would you like these rules written? This is the way it would have, just look at the text of Basel II, and that's pretty much what they would have wanted. Now, I think that's an exaggeration. But I think his point was that this dynamic that I described at the international level has produced this kind of outcome. All right? The monitoring problems, which many of you are familiar with in a variety of institutional contexts, combining with the dynamics of something that resembles a negotiation over details as opposed to that early kind of Basel Committee work to just coordinate, make sure there are no regulatory gaps. All these problems come together and produce what I think is a decidedly suboptimal international arrangement and a really bad domestic regulatory arrangement. Now, you can reach many conclusions from this, right? And I'm not going to press too hard on my conclusions as flowing ineluctably from my observations and analysis. But at least for heuristic purposes, for purposes of testing, for looking in the next case, for seeing what happens here, here's what I'm coming to believe. I'm coming to believe, and now I'm speaking a little bit contrary to what people of my political inclination would have thought going in. Beginning to think that efforts to get a lot of harmonization of national regulatory laws are probably misguided. In some respects, for the reason that conservative law and economics people have said. But remember, conservative law and economics people think that it's an affirmatively good idea to have regulatory competition among countries. My views on that vary from issue to issue. So I'm not with them on that. But I am with them on where the principled conservatives say, look, when you do this, every time you raise the level at which these regulatory decisions are being made, you are making it more difficult for people, the journalists, the public, academics, to see into what's going on. You are thus increasing the opportunities for economic rent-seeking by the regulated industry. And that, I think, is true. My little addition to this is to suggest that what I've described as the trade negotiating dynamic and the impact it has on domestic political economy reinforces the rent-seeking possibilities and takes out of play actors who sometimes counterbalance that domestically. So I'm actually now in favor of having blunter, simpler rules that apply to things like capital internationally, knowing that they're imprecise and not adequate as a whole regulatory paradigm, but saying get a kind of baseline, get a floor that is easily defined, easily implemented, and easily monitored. You get the accounting report, you get the certified accounting statement of a big European bank. You can calculate simple capital levels, no matter who you are. Okay? That doesn't get you everything you need from banking regulation, to be sure, but it does provide a kind of baseline so that everybody knows that there's at least some baseline of stability that the banks that are dealing with their banks have, and there's at least some level below which banks in another country won't get a competitive advantage. All right, so that's my lurch to the center right from what my beginning position would have been. Now here's my lurch to what has traditionally been thought of as a kind of center-left idealism. I actually think the second piece of this is genuinely supranational activity. We almost always rule that out, right? We always say, nobody will ever agree to giving up their sovereignty to some international organization. It'll just be, black helicopters flying in from the UN shooting down our banks. We can't have something like that going on. All right? I think a hard-headed, rational analysis suggests otherwise. This big problem I was talking about with monitoring, there are going to be sophisticated bank models regardless of whether the rules are complicated or simple. My preferred solution is very simple rules that are easily monitored, but a requirement that banks have the most sophisticated risk management models they can find, and that they work hard at making them work for them, and thus that they operate their businesses as sensibly as possible. Well, if they're going to have these models, you're going to need to have examination, supervision, and validation that those models are good faith, sophisticated models. So we're back to this problem of monitoring. Well, how about this? If you had a unit attached to the Basel Committee on Banking Supervision, which was composed of 50 of the smartest, most adept financial bank regulators in the world, who are on some indefinite detail or may even become employees of the Basel Committee. And it was their responsibility to do the examination and validation of the models of the 25 largest banks in the world on a rotating basis. What have we got then? We've got a concentration of expertise. We've got the ability for a consistent mode of looking at these models among banks so that the same people learn what there actually is going on around the world. We've got some assurance that there's no national favoritism here, that the Fed examiners are not saying, this model's a little on the shaky side, but we don't want to tighten it up because then Citibank won't have as much money to lend and they'll be at a disadvantage with Deutsche Bank. So you get rid of that as well, and you provide some outlet for some way of the Congress of the United States, of academics or other people, knowing that somebody is looking over the shoulder of the Fed as well as the banks. Is it a perfect solution? No. Is it a full solution? No. But I try to be suggestive here that instead of the traditional left-center aim of harmonization, more international stuff, more agreements on this, that, or the other thing, that a more feasible, and not just politically feasible, but administratively feasible, and a sounder political economy basis for regulating transnational activity in a world of nation states may be to keep the international dimension quite simple, notwithstanding the complexity of the industry, and to begin to move some of the functions, particularly monitoring, examination, things that are not actual decision-making, up to a genuinely supranational entity that has the kind of expertise that would escape any national entity just by virtue of the fact that somebody's looking global and the others aren't. Okay? So that's a long-winded way of arriving at a counterintuitive conclusion. But I think it's a kind of analysis and thinking that's going to need to be done if we're actually going to tackle the problems of regulating transnational activity in a world of nation states, because the alternative is what? The alternative is treaties about everything, committees about everything, the needing to monitor what everybody's doing about everything. Something which I will tell you by experience as well as by theory is a prescription for slow-moving regulatory responses, something that you cannot afford in a world in which financial innovations are happening overnight and capital literally moves across the globe with hitting your enter key on your computer. All right? So I ended exactly at 10 of.
Well, I promised Professor Tarullo that we would not keep him longer. Maybe he'll stay for a few
Yeah, I
minutes.
can. If you want to go to your
I
class.
have to go teach class.
Did you leave your door open so I can get in there?
My office?
Yes.
Yes.
Okay.
I'll leave it open. But you have to meet your son too at some point.
Yeah, that's right. That's why I have to. But I'll take a few minutes. Okay.
But I think we should give him a round of applause.
Okay. All right. So I'll see you. Okay. I'll see you in the morning then.
Yes.
Okay. So I'll be here as early as you'll be. 8:30. Yeah.
The classroom will just be around the corner, so if there's any-
Sorry. So are there questions? No. Oh yeah. Sorry.
So you talked about, one of the fundamental problems here is there's no supranational regulatory framework. I mean, there's a framework, but there's no enforcement mechanism. And you alluded.
Sorry. There's not a supranational. There's an international. And I'm catching you on the terms only because we need to be clear about the kind of arrangement that it is. By supranational, I mean something that sits atop the system and in which the individuals in question are not responsible to their national governments.
Right. There's no committee that's basically saying, you in the United States, you do this. You in Canada, you have to do this, right?
Right.
So, and you said that's going to cause a problem because, Deutsche Bank and Bank of America and Wachovia might therefore adopt different principles or, might stray from the framework in some capacity. But it seems like the real problem here is if this, is it Basel? I've heard both.
They ask that they be called Basel. The people in the city of Basel have now formally requested that the rest of us and the rest of the world call them Basel. So now you're going to call them Basel? No, okay.
But you showed that there's this really sort of sophisticated risk measurement system with it takes two blackboards to write. That seems like it's fine for Deutsche Bank. It seems like it's fine for Wachovia. Even if it costs a lot of money to implement, they can do it. It seems like the real problem is in some economically marginalized country, right? Because they may not have the resources or the capacity.
That's right. I didn't even. Yeah, I'm sorry. Go ahead.
But so if that's in fact the case, then aren't they going to necessarily be sort of restricted from credit, or the credit's going to be a lot more expensive?
Just because of time constraints, I didn't give you a full explanation of the Basel II agreement. The big innovation is this internal ratings-based approach that I described with the complicated formulas and these things, by the way. Citibank estimated it would take $200 million to develop this. Okay, so your instinct is right about the big upfront for one bank, not for everybody, for one bank. There is something called the standardized approach in Basel II, which is a variant on the original Basel I, 30 pages. It's sort of like 40 pages now. It's expressly intended for smaller banks in the industrialized countries and for adoption by the lion's share of banks in developing countries. There are going to be some banks in developing countries which will go to the advanced approach, but not that many. So actually that issue of cost and the cost-benefit trade-off for extremely complicated regulation, they did take that into account. We're talking What I'm talking about is the group of banks who do have the potential to set off a systemic crisis if one of them fails. Because to me, the regulation of those banks raises issues of a different order of magnitude from that of a regional bank in the United States or a smaller national bank in Bolivia or something. Okay? Anything else? Yeah.
It seems like sort of the really interesting and crux of what you're saying in your argument is this supranational arrangement. I'm wondering about sort of the first level that you mentioned, the baseline level. What are some of the complications that were attendant with the initial proposal that you're talking about? How would those not be a part of setting that baseline level?
You mean my simple rule approach at the international level? Yeah, well, I mean, they might be. And this is where generalizing conclusions across industries, for example, is obviously premature because you've got to look at each industry. But let me tell you how in the banking area it would work. Okay, so I told you there were 30 pages for Basel I, risk adjusted, 300 pages for Basel II, complicated formulas and all the rest. So here's, whoops, is this open? I don't know. You can.
We do this for presentations, no one knows why.
I think it's for the light in the end.
Oh, is that why?
Yeah.
Okay, well, that's all right. I don't want to rip anything while I'm here. But what I was going to do is I was just going to put up on the board, there's something called the leverage ratio. Leverage ratio tells you to take something called core capital, and you do have to calculate what that is. Some things qualify, some don't. You take core capital, and that's the numerator. And then you take as the denominator the total assets of the bank. And you literally just convert that fraction into a percentage. And the percentage has to be above a certain threshold. In the United States, we require that a major bank have a leverage ratio of 5%. Okay? That's it. My research assistant, she's very good, but she's still a 2L, right? And what I said, Sinead, go off and give me the leverage ratios for the top 25 US banks, the top 25 French banks, She was back in 2 days. I mean, she's a little compulsive, but that's good for a research assistant. But she was back in 2 days, and she had them all because she was just able to get the bank, reports that the banks all have to file with their supervisors. The reports themselves have to remember they're based on the stuff that their accountants certify, so there is an outside look. And then she just did the division. Okay, she just did the division. She knew what the core capital was going to be after she looked at a couple. She got good at it, and she was just able to do that very quickly. That's the kind of simple rule that I'm talking about. Simple, it's simply verifiable, it's simple to monitor. It is blunt. There's no question, and that's why it doesn't solve, that's why it's not an adequate basis for regulating a bank. But what I'm saying is we have to be clear about what we're asking for in the international arena. We ought not to be looking for harmonization for the sake of harmonization. I think the EU sometimes get caught up in that a little bit internal to the EU, but for the rest of us, where we don't have a European project that's gripping us, we really have to think, well, what are we achieving? What are we trying to achieve through these international arrangements? We're presumably not trying to achieve harmonization for its own sake. We're not trying to achieve best practices. If something is a best practice, you don't need an international arrangement for guys to adopt it. If it's the best thing to do, they'll adopt it. Okay? What we're trying to do is put a floor here. We're trying to make sure that banks in your country are safe enough so that they don't pose the kind of risk that Herstatt Bank posed back in the 1970s. And I'm doing the same. So we put that simple rule in. You know it's there. I know it's there. We all know it's not adequate, but we also know that it's something and it is a baseline. And then we have this very sophisticated model and mechanism, which by definition cannot be reduced to a set of rules because there's too much discretion. And that's when I introduce my supranational entity. Okay, that's kind of the way. It's the way I do it. Now, and by the way, let me just say, one of the I gave a little talk like this in the Princeton economics department when I was teaching at Princeton. And I put the formulas up on the board for them. That made them very happy. It really did. They just. But one question I got, which was an interesting question, was, said, well, look, you've just been making this big deal about how it's hard to monitor what's going on. You found out, all right? So what's a big? Yes, I did, but we don't want to rely on former government officials who happen still to have friends in places where they kind of know what's going on, and they call you and they say, you know, you may want to, this is going on and nobody's paying attention to it, and there's just too much serendipity involved. And I think we need a system that produces enough transparency so that, and this is an important issue in globalization. People worry about accountability. And everybody's always thinking that accountability is somehow that people have to vote on stuff or the guy making the decision has to. There's a different conception of accountability, which is if there's enough transparency as to what is going on, there's the opportunity to get a debate moving, even in a single country, but these days they cross, blogs mean that the debates are internationalized in the snap of a finger. If there's transparency about what is going on, I think the step to accountability is not nearly as hard as people think it is. It's when it's really difficult to figure out what is going on, what are the bases for decisions, that the operation of insidious political economy is, which is just a fancy way of saying lots of rent-seeking company, the regulated trying to turn the system of regulation to their own advantage. Those opportunities increase. I mean, I don't have the, and I'm not relying on the sunshine is the best policy and da-da-da-da-da-da-da, but I actually think there's an important element of it there. And in that respect, I do think that going the simpler route actually will make it easier to have the sophisticated discussion. Okay. Anything else? Yeah.
If a bank establishes a subsidiary bank, a wholly owned subsidiary bank in a foreign country,
Yeah.
under the local country's law,
Yeah.
so that subsidiary bank will be supervised by the local country.
Well, that's a great question. So you have more to say?
Yeah. But meanwhile, the subsidiary and the bank has a very close relationship, so will it cause new problems about the regulatory?
Yeah, well, that's an excellent question, and that actually gets us back to BCCI, because that's what happened with BCCI, is just what you said. Okay, the subsidiary was regulated locally, and nobody was paying attention to the relationship between the sub and the parent in Pakistan. Okay, so part of what the Basel Committee has done is to try to institute this concept of consolidated supervision with so-called home host agreements, meaning that, here's a good example. Citibank is regulated by the Office of the Comptroller of the Currency, the U.S. regulator of national banks. Citi has, as I said, either branches or subs in over 100 countries. Every place it has a sub is perfectly entitled to regulate and examine the sub. But here's what happens in reality. In reality, the comptroller and the Fed have their on-site examination team in New York on the 20-something floor of the Citigroup Center at 53rd and Lex. I passed the office. It's like the only badly furnished offices in the Citigroup Center. That's the government. It's the government office. And they actually, when they look at Citi's books, they don't just look at Citibank of Delaware N.A. They don't just look at City National Bank. They look at everything from every sub, branches by definition, of course, are just part of the bank, but every sub in every part of the world. It's to avoid the BCCI situation and to give them a better sense of Citi as a whole. Now, that's the consolidated supervision that we're talking about. And by the way, they require consolidated capital as well. So they say you got to meet the leverage ratio and the risk-adjusted ratio for your worldwide assets. Now, the sub of city in, I'm just going to make up a country, in, let's say, no, Argentina's a bad country to make up. Japan. Had a lot of problems there. But they do have a sub in Japan. Okay? The Japanese Financial Services Agency will examine the city sub to make sure it complies with local law in a variety of ways. But for purposes of the assets and all the rest, they will, to some considerable extent, rely on city's examination in New York. And they'll pass information back and forth. The FSA and the Office of the Comptroller will pass information on city back and forth to try to get a sense of what's going on. The interesting thing about the question you asked is what is contemplated under Basel II? And under Basel II, what is intended is that capital regulation will be done on a consolidated basis so that now take it, 80% of the banks and banking assets in Mexico are under the control of foreign banks, dominantly from the US and other OECD and other Basel Committee countries. Under the Basel II concept, capital regulation will be done by the US, and Mexico is not supposed to have independent capital regulation of those subs, because if they tried to do, for example, the standardized approach, that simple one that I said in response to that fellow's question, it would be inconsistent with the sophisticated internal ratings-based approach that's being done for the bank as a whole. Now, the Mexican authorities just realized this a few months ago, and they are not happy campers, so far as I can tell. And I don't know how it's going to be worked out, but you see the kind of issue that gets raised here once you're saying, gee, we need consolidated supervision, but if we need consolidated supervision, we can't have all the host countries doing their own examinations, which again leads to the issue of, is the US examiner going to be doing things that favor city over Mexico? I don't know the answer to that. We'll have to see how that goes. Yeah, I'm sorry, you had a question?
I had two comments. First, your anti-harmonization logic only goes so far because I'm sure you wouldn't argue for anti-harmonization for, say, immigration law within the United States. I guess, whether regulations should be harmonized depends on a number of factors, and I guess one of those factors is whether it's possible to reach any level of harmonization and what the benefits are. And a priori, it would be very difficult to predict whether harmonization of regulation of the banking industry would be overall beneficial or detrimental. And that's one point.
Okay.
And the second point concerns your suggestion for simple rules. And, unfortunately, financial modeling and risk assessment are not all that simple. And the vast majority of the financial models in that particular area are still in the infancy, basically. And I'm not so sure whether it's possible to devise a good, simple solution for a complex problem without first trying to experiment and see sort of what kind of approaches work and what doesn't work.
Okay, so let's take the two questions. Okay, let's start with the second question first. Yeah, of course, financial services is very complex. The city's business is infinitely more complex than it was 35 years ago. I mean, you just look at the composition of their balance sheet, it's a very different world. But and thus the answer which some of the regulators have given is, well, of course it's a complex 300 pages, it's a complex business. But we're talking about two different things here. One is managing complicated risk, and the second is implementing a mandatory regulatory system. I certainly believe, that we need banks to be using state-of-the-art risk management techniques. And one good thing about the Basel II process is that it has pushed banks faster down that road of learning more about credit risk modeling than they otherwise would have. Learning it faster. They would have done it, but they're doing it faster. They're deploying more resources. But whenever you're doing a law and a regulation, you need your regulatory concept to be sensible, to accord with the economics of the situation, whether it's financial economics or micro or whatever the form of economics is, for sure. But you equally need to be cognizant of the potential and the limitations of implementing that model or that paradigm in a real-world administrative context. And that's where all the considerations of the competence of examiners, the incentives of examiners, the political economy of how banks will be able to affect things, the administrability of things, the costs involved in developing the information that would be necessary. All those sorts of things are, if you will, a part of the law or the paradigm as embodied in an administrative system. And it is now my judgment, which it wasn't when I began this project. I should tell you, when I began the project, I didn't think I was going to come to this conclusion. But it is now my conclusion that any effort to have an extremely complex set of rules for bank capital will invariably commit one of the two, or one of both of the following mistakes, and I think both, which is really bad. Either one is just what I said a minute ago. You'll have a set of rules that it turns out can't be administered in anything resembling a cost-effective, efficient fashion, given our resource limitations, given information costs, and all the rest. Or two, in an effort to get something that is administrable, there will be a forced uniform quality to the rules, which will then obviate the benefits of a bank doing its own sophisticated risk management tailored to, customized to the particular risk profile of that bank. What I fear Basel II has done is get the worst of both worlds. On the one hand, we've got something enormously complex that we can't monitor, can't actually figure out what's going on. And on the other hand, we're saying to the banks, we don't really want you to use the most sophisticated model. You know what's You talk to the bankers. When the bankers are in the hearing room, they say, oh, this is a wonderful thing. This is a good thing. And then you go out and you talk to them later, out in the corridors. And right after the hearing I testified at with the banking. Go out in the corridors and they say, well, this is a crazy system. I would never do this. But we get to reduce our capital by 20%. Hey, we'll do anything. if we get to reduce our capital. Okay, that's number one. Number two, your first question. Of course, harmonization. And the way you put it, there are costs and there are benefits to harmonization, and you don't know. When you said ex ante, I would say a little bit different. I would say until you're looking at the particular industry, you don't know in the abstract whether harmonization is going to be sensible or not. You've got to see what the problems are, what the advantages are, why you need it, and all the rest. I agree with that. But your choice of the United States actually puts in sheds light upon why I'm making my argument as I do in the international context. Remember, I said regulating transnational activity in a world of nation states. The United States, for better or worse, has the capacity to have a single, binding, enforceable regulator at the national level. And indeed, much of our national regulation was put in place precisely because the states were competing with each other and playing favorites to their industries versus other industries. So it's exactly that dimension of the sovereignty gap at the top that lends a different quality to this kind of analysis than a national analysis. Now, having said that, there may be cases, I think there probably are, where the case for international harmonization would still be a convincing one because the underlying reasons to harmonize substantively outweigh all these costs. I don't think banking is one of them. So too, as you I'm sure know from just studies here, there is still a good argument to be made that in a lot of areas in the United States, we should allow more toing and froing and experimenting by the states and not have top-down regulation on everything. So your points, I think, are all absolutely correct. What I'm saying, though, is that if you put everything together in this context, the differences of the absence of the sovereign stuff at the top and the difficulties in getting a particular regulatory paradigm working in the actual world in which we live are sufficiently daunting that I think they become counterproductive here. Okay. In order to meet my kid and get dinner and get to Cameron on time, I probably should stop now. But I thank you all for coming late in an afternoon. Okay, it's nice seeing you all.